Our current economic situation presents a paradox in which numerous recession indicators are flashing red, but the actual downturn is delayed and has yet to materialize. Now, this delay may be caused by unique post-pandemic dynamics where traditional forecasting methods have actually been disrupted. Famed economist and Johns Hopkins professor Steve Hanke warns that we've had 4 monetary contractions in the history of the Fed since 1930, and every one of those has led to a deflating economy and ultimately a recession. And we've just experienced one of the most aggressive rate hike cycles in history. And so while some economists are optimistic that we may be in the all clear with a soft landing, there's still many major recession indicators on the table that we need to consider. And one of the most reliable recession predictors is the initial jobless claims, and this figure has actually surged 20% since January of 2024. Historically, these upticks have preceded every U.S. recession. Now, the Bureau of Labor Statistics has found that declines in temporary employment typically precede recessions by 6 to 12 months, and we're seeing this pattern emerge right now. The inverted yield curve is a historically accurate recession predictor that occurs when short-term interest rates are actually exceeding long-term rates, and it's a sign that investors don't hold high hopes for future growth. It's been inverted for 2 years, which is the longest stretch since the 1929 crash. And there is a major growing disconnect between rising stock markets and increasing unemployment. This pattern was observed before the recessions of 1988 and 2006, and since January of 2024, the S&P 500 has climbed approximately 15%, while jobless claims have also risen significantly. We also have the SAM rule, which is a near-perfect recession predictor developed by former Fed economist Claudia Sam. According to this rule, a recession is likely when the 3-month average unemployment rate increases by 0.5 percentage points over the previous 12 months. As of June, this increase stood at 0.43%, and it looks to be climbing. And then finally, we have the M2 money supply, which is a measure of how much liquid cash and other liquid assets are flowing through the economy, and it has been contracting for most of the last 2 years. Now, Steve Hanke explains that the interest rates will need to come down drastically to keep the economy going, but he doesn't think the Fed will act in time to avoid a recession, and he's calling this one of the worst performances of the Federal Reserve. And while precise timing remains elusive, many analysts anticipate the recession to hit the latter half of 2024 or early 2025. This projection comes after the stock market's recent record highs, signaling a last gasp steep climb, which usually occurs when recessions begin. Now, investors should brace for potential sharp market corrections as we go forward. Now, the convergence of these signals suggests an economic downturn is inevitable, and investors should consider taking the current window to prepare. So if you're concerned about the direction that things are headed, I'm Makai Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals into your portfolio can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.